Morning, everybody. Good morning, everybody. I would like to introduce you to Prashant Khemka, who is the founder of the White Oak Group and the manager of the White Oak Ashoka Indian Opportunities Fund. Prashant has a long career in managing assets. Previous to founding White Oak, Prashant was CIO of emerging markets at Goldman Sachs Asset Management and the manager of the Goldman Sachs India Fund and the EM Fund. In 2017, he founded White Oak Group, and he is a AAA rated Citywire manager. And I'd like now to hand over to Prashant. Good morning, Prashant.
Hi, good morning, Philip, and good morning, everyone who's joined in today. Thank you for taking the time and joining us this morning, afternoon, as the case may be. So the subject of discussion is really the surge of COVID in India. And I guess what people are interested in is various aspects of this second wave, if you will. But I assume what is of greatest interest is the implications for the market, the portfolio. Maybe there is some interest in what's the implication for the economy and the corporates, and maybe there is some interest in the humanitarian aspects and the health situation as well. While it may seem all are very much interlinked, it may be interlinkages are less so than what may be, on people's minds. So let me ask the other team members on the call as well, including Ayush Abhijit, who is been on the team from very much the start of the firm, and Dipojal, who's joined us as portfolio strategist earlier this year. And they might jump in from time to time again. Philip, thank you for the generous introduction. I just wanted to one clarification from you. It's about a hour's call. Is that right?
And we've got up until 1:30 India time.
Okay, so that's what. Okay, all right. So we'll see how it goes. So let me start with, and Dipojal, if you can bring up the your COVID specific presentation, that will be helpful. Let me start with a caveat, and then we'll move to the conclusion and then dig into more nitty-gritties. First, let's go to the last slide of this one. So we will be discussing a lot about macro today. I want to make sure we don't leave an impression that macro plays any important role in our investing process, or that we spend a lot of time on macro. Neither one are true. Macro plays almost, well, other than the fact that we want to make sure our portfolio is balanced to all macro risks, there is macro plays no role in generating returns for our portfolio, and hence we spend hardly any time worrying about macro, and most of the time is really in client interactions that we end up spending on macro, because obviously clients do want to discuss macro. Otherwise, from the portfolio perspective, we always remain well balanced in the portfolio. Whether the market tanks like it did in March last year or rallies like it did since then, that per se should not determine the relative performance of our portfolio, is how we think about it. And the only way to achieve it is to have a balanced portfolio at all times that consciously avoids macro bets or top-down exposures and whatnot. So in fact, I often say that we hardly ever have any view on the market or on the macro top-down views, if you will. If at all at any point in time we have any views, we hardly have any conviction in those views. And if at all, at any time, we have conviction in any of those views, we go out of our way to make sure that those views are not reflected in the portfolio. Underlining, not reflected in the portfolio, and portfolio remains well balanced. So with that, let me now, after those caveats, let me move to the conclusion of what we are going to discuss, which is what on top of everybody's mind, I believe, is how the COVID surge might impact the market. In our view, and again, we don't have strong conviction in it, but in our view, the this surge would have hardly, if any, impact on the markets. And the reason is because it's very different from last time. Last time people may say, oh, last time, markets tanked so much in the first wave. Just to remind everyone, the market last time bottomed when on March 23rd, when the case count in India was still on a daily case count was double digits only, like 75 cases reported. Today, it is almost 5,000 times larger, and yet the market is within 2% or 3% of its highs. At that time, the number of deaths were in single digits. Today, obviously, they are in thousands, right? So why the dichotomy? People say, when oftentimes clients, ask me, when would the market catch up to reality, right? Suggesting that the market is naive and missing something. But actually, the market has behaved extremely logically. It behaved very logically a year ago when it tanked. It behaved very logically when it then rallied over the next 12 months. And it is behaving very logically today by not tanking despite the surge. So, why we say so is, see, in March, if you put yourselves back into March of last year, if we put ourselves back to March, at that time, Corona was a risk that had unlimited and indefinite downside for the market and the economy and whatnot. The limited data that was available was coming out of China, which to begin with is highly unreliable. But what data was there was that there were a few thousand deaths, call it about 3,000, and there were 60,000, 50 to 60,000 odd cases. So that suggested a mid to high single digit mortality rate. So one data point that we had was mid single digit mortality rate. Second was highly contagious and asymptomatic disease. And third, no vaccine or medication. And everyone, if you remember back then, many people would say that vaccine takes 10 years to develop, if one can be developed at all. There are many diseases like HIV and others, including common cold and all, where vaccines haven't been developed for decades or for centuries. So there's no guarantee that a vaccine would be effective or developed even in a decade. So there was unlimited, if you combine these three, high mortality, highly contagious and asymptomatic disease, so you can't even isolate people in time before they pass to others, right? And third, potential for no vaccine or medication. That spells a doomsday scenario for humanity and for equity markets as well, because it means corporate cash flows can have a step function down and collapse and keep collapsing for years to come. Because under such scenario, if there's no vaccine, medication, and mid-single digit mortality and highly contagious and all that, there would be no solution but to stay locked up at homes for a prolonged period of time, a very prolonged period of time, indefinite period of time. There was no definitiveness to how long people would need to stay at home. It was just uncertain what the outcome of this would be, right? And assume in such scenario where worldwide there are lockdowns for many months or even years, what that means is all travel and transportation companies would go bankrupt first. Obviously, consumption of a lot of different materials, particularly crude and anything related to transportation would go down more or less to zero. That's why, crude prices fell dramatically. Other commodity prices could get affected very severely as well, including steel and whatnot. These sectors tend to be heavily leveraged, the airlines, the commodities, and all. So they would default on their loans to the banks. Banking is the largest sector, 20-30 sector. They'll all start going bankrupt. So once so many companies go bankrupt, this could have evolved into a crisis far larger than the global financial crisis or the Lehman crisis of 2008, which is what people were comparing it against and were saying this is much worse than the Lehman crisis. And there was a scenario in that, I mean, there was no normal curve. It was like a flat probability curve. There's a lot of fatness in the tail risk, right? So it made logical sense for market to reflect that possibility. However, the market started recovering very rapidly when it started becoming apparent that the mortality rate is nowhere near what was being feared, mid-single digit. And market doesn't need stories to be printed in media publications or even scientific publications. Market somewhere must have got a whiff that there are credible candidates for vaccine and there is a reasonable probability of vaccine getting developed in not so distant future. And hence market started recovering. And by the time a vaccine got announced in November, market had substantial recovery. Obviously, we had the best November in the US market in last 30 years or something upon the announcement of both Trump losing, which is quite funny because everyone was predicting the markets would tank if Trump were to lose. And second, or if people were predicting if there was a mixed outcome, unclear outcome, which is what we got, but still market rallied. And then the Pfizer vaccine was approved in early March, right after the election results, and markets have continued to move higher since then. So where we stand today, of those three factors, what we know is the mortality is much lower. Instead of 5 people out of 100 dying, 1 person out of 500 is dying. That's a 20 plus time difference in mortality rate. Second, there are many effective vaccines, and they are, while you see numbers like 60, 70, 80% effectiveness, in reality, they are 100% effective against, or close to 100% effective in safeguarding against deaths, right? So when you now combine these two facts, that mortality is extremely low and vaccines are highly effective, it is a very definite time problem now. It is a very finite problem that people can put their hands around, unlike a year ago where it was a bottomless pit, right? And that is why the markets are not reacting, because markets ultimately are present value of future cash flows into perpetuity. And the markets can see at worst, the hit could be over the next few months or couple of quarters. And even if, next couple of, from going back to the equation, markets present value future cash flows, this year's cash flow is only 2 to 3% of the value of a company and hence of the market collectively. Even if half of the year, let's assume 2 quarters, get shaved off by 20%, that is a 10% hit on a full year number. That's less than 0.5% hit to the present value of future cash flows. As long as the hit over the next quarter or two does not cause any permanent hit to the corporate cash flow, which, as last time's experience shows, was not the case. The economy was bouncing back with a vengeance, and the underlying demand was extremely strong till March or till even April. It's only last 2 weeks that implementation of the localized lockdowns over the last 3 weeks has caused some moderation in demand and other high frequency data. So I'll pause there and answer more questions on this later. But in our view, the market responded very logically last year, given the circumstances and the developments then, and what were the risks at that point in time. And right now, the market is behaving very logically because there's a finite end to this. Now so we've talked about the caveat that none of what we discussed today affects how we manage our portfolio. Second, what we've discussed is the conclusion that logically speaking, it ought not to impact the market. Last time, why it was different. And now let's talk about what the situation actually is. So if we go to the first slide, so what this is the top left hand side, and pardon us, just forget the blip at the end that is shown, because I have not checked the data myself and I do have some doubt on the data. It must have softened further, but this was just put together, and I thank Dipojil for putting together, and I may be wrong, this data may be right, but it just looks too good to be true. So just forget for a minute the very last um, you know, arrow down. Just ignore that for a minute, because that does not affect any of the numbers that are shown in the table below. Okay, the table below is before that blip down. So what, even if you are put aside the blip down, what is you can see is the curve is somewhat bending, especially the new case curve. And the data available on the deaths also, they are somewhat, I'm not saying flattening, but the pace of growth is decelerating. Um, Now, if you look at the table below, that is to, drive home the point that let's keep in mind the scale of India. When you hear 400,000 cases on Bloomberg, it shows it breaks the pandemic record in any country. 400,000 reported cases in India are equivalent to 100,000 reported cases in the US. For a minute, if we assume that there is no similar degree of underreporting, the fact is that there is greater degree of underreporting in India of the reported cases, but for a minute, the number 400,000 itself should not be that shocking when you have seen numbers like 300 plus thousand in the US or similar numbers in Brazil. So scale of India is very important to keep, as you see on the table below. So it is a crisis, nothing to take away from that, but the crisis seems very amplified due to the scale of India. The table below shows the population of the various countries. So India's population is 1.38 billion. To put in context, Israel's population is 9 million. So India is, 150 times in terms of the population. If I'm doing the math, right? Yeah, the math is right, right? Median age in India is lower at 29 years compared to, say, US at 39 years and UK at 41 years. The median age in India is similar to Mexico and Israel, where Israel is 30 years. That's one of the key contributing factors in lower mortality in India per million. And mortality numbers in India are more dependable than reported cases, because a lot of asymptomatic cases go unreported because of they don't even get tested. But deaths do get reported, because you need a death certificate for anything in life for the family in future. They need death certificates, so deaths get reported. There could be some underreporting from rural areas, but nowhere in magnitude compared to underreporting in cases, and it would not be in multiples. There could be 10, 20, 30% of underreporting at an aggregate level on deaths. But the lower mortality is due to age. Now, the mortality could have been even lower in India if we had good infrastructure and healthcare facilities, which we sordidly miss, as is becoming very apparent now when the case count has increased. So the mortality is higher in India right now than what it ought to be because of inadequate facilities, which is a very sad situation. And you must be reading all these stories, which are very. I'm glad that Western media, which I typically am critical of for blowing up out of proportion anything related to negative related to India, but here I'm happy that they are properly highlighting the situation, as that has attracted attention of everybody around the world, and necessary aid and all is flowing into India, which is even if it's saying a certain number of lives, that's highly desirable. So, but when you look at these numbers, you have to again bear in mind the scale of India. So if you look at the right three columns, daily deaths, peak 7-day average In India, it is at present 3,400 peak 7-day average. We are more or less at peak, though it might have slightly come down, though not to the degree that is shown in the graph, but it could have slightly come down because last few days the number of deaths have been stable. You see that US had peak deaths of 3,400, Brazil had peak deaths of 3,100, and so on and so forth. Israel had peak deaths of 65. Now, if you scale those up to India's population size, that would mean US equivalent of 14,000 deaths, Brazil equivalent of 20,000 deaths, UK and Spain 25,000, and even Israel at close to 10,000 deaths. So scaled up to India's population, if you look at the rightmost column, the severity of India on the deaths, assuming currently is the peak, maybe the peak has still some ways to go, but at present at least is a fraction of, it's 25% of what US was at its peak, and so on and so forth. It's just that in India, it's happening in a very brutal manner. People not getting access to oxygen is the single biggest reason for death. So whether you call it people dying because of COVID or people dying because of lack of availability of oxygen, hard to say. Obviously, COVID is causing lack of oxygen. If you go to next slide now, so how this would progress going forward. Let's take an example of two countries, UK at the top, Israel at the bottom. So they've been in India, if you noticed, if we go just back to the previous slide, see what happened was India had one wave, a fairly muted wave because the lockdowns were very effective last year. And there was complete complacency just 2 months ago. Till late March, people were taking vacations all over the country. Some of my own team members had gone for vacation. I mean, I'm paranoid, but end of March, people had gone for vacations. Other extended family members till March 31st were going on vacation in India because the case count were closer to, till March 20th, they were closer to 20,000, which is nothing given India's scale. But all of a sudden, the spike started from early April, and by mid-April, it just became a humongous crisis, and so it's come very, very sharply. It's the second wave that the country has faced. But until March 31st, everyone had assumed that India is behind. I mean, COVID is behind for India. If we go to now next slide, it shows how it has happened in UK in the top slide. So maybe you can just look at the death slide because there's pretty much the same data, or you can look at the cases on the left side. But you say UK was the third curve that hit around the end of the year last year. And if you just look at the left side of the curve before looking at how it declined, the situation was extremely alarming, similar to what you see in India today. Israel, which has obviously been the most successful at vaccinating its population. But before that vaccination drive started at the start of the year, you will see on the lower right-hand side chart how the third wave had caused a dramatic rise in deaths, peaking at about, if I'm reading the numbers right, at 60 or so, which for a country the size of Israel is fairly high. And then it dramatically came down as a successful vaccination. So the solution for India is the same as the solution for Israel and UK, which is vaccinations. And we'll come to the next slide now. This is again a case study for Israel, and you probably, our data correct us if we're wrong. We just put it together based on the best we could collect. If you look at the top half of the page, you'll see that somewhere around mid to late January is when the case count started, around 21st, third, fourth week of January. Case count, the vaccination pace reached at about 25%, around 20th of January. And then continued to increase. Now at least 60% of the population or more in Israel has received at least one dose, right? And a huge proportion of that have received both doses. 55% or so have received both doses. If you look at the bottom left-hand side graph, the daily cases started declining in Israel around 16th January or so was the peak. So just before 25% of the vaccination was reached. The deaths peaked around 23rd of January as well, right? And continued to decline going forward. So it seems from at least Israel's example that about 25% of vaccination coincided with the peak. Now, in India's case, likely the peak would be earlier, and the reason is because there's a certain higher degree of natural immunity might be achieved by the time 25% of vaccinations would be given. But let's assume 25% for a minute is where the declines would start. If you go to the next slide now, so India currently, the vaccination progress has been somewhat slower because the government in a way got caught um, um, sleeping, if I may say, where the vaccination drive started very slowly in January. There was no sense of urgency. Initially, despite having a lot of vaccines, the vaccines were only, eligibility was only for healthcare workers and frontline workers. And then it gradually started to people over 70 years of age and so on and so forth. So the stockpiles were there. Country was, you know, um, so-called vaccine diplomacy was there, where India was granting vaccines to other countries in dire need because we didn't seem to need in a hurry and all that, and the production is would take care and all that. And so the progress was fairly slow uh, then. And then in March, April, particularly in April, the vaccination picked up. But by then, we started running out of stock, the accumulated stock. So the production wasn't ramped up that quickly because there seemed to be no rush. And then whatever stock was stockpiled, we ran out in April. As we speak today, a little over 10% of the population has received at least one dose. So it's like 11 to 12. So over 150 million doses have been administered. So 11% of the population have received doses, and couple of percent have received two doses. But there is enough immunity you get with the first dose as well. The expectation is over the 4 months, next 4 months, the vaccine production is going to be ramped up. So there are, all these vaccine producers, they have talked about the ramp up in production because, as I said, in April, everyone focused on it and the focus was increased. So India is importing vaccines. India has approved almost every vaccine that has been globally approved. So there are vaccines being imported, vaccines being donated by certain countries or granted by certain countries, including US, which has a stockpile of extras AstraZeneca but is not using it. So that's going to give some 20 million doses. So taking those into account, Dipojal, who's on the call today, he's prepared this graph or expected pace of vaccination going forward. So by the end of August, it seems more than 40% of the population, about 600 plus vaccines would be administered, 600 million or so would be administered. Even if you assume about 10 to 20% would be double doses within that, at least more than 500 million of population would have received single dose. The 25% figure is expected to be reached in somewhere in late or mid June time frame, or early to mid June time frame, which is about, say, 6 to 7 weeks from now, is where 25% figure is expected to be reached. If I'm looking at these graph, correct me if I'm wrong. So no, May. So mid-May is where, so late May is when we expect to reach high teens, and it would be late June where the 25% of the population is expected to receive at least one dose, which is about 2 months from now. We happy to go into more details of this, but between now, where the production is 75 million doses per month, availability is 75 million doses per month or thereabouts, expectations are the availability would become 150 million doses per month in August, based on the announced plans for production and imports. If we go, so 2 months time or less, we should start seeing the curve come down. It's already, as I said, the band is apparent, and it could quite likely come much earlier because of the natural immunity that a significant percentage of the population would already have achieved. If you go to the next slide, this shows already, so in this second wave, which started in, let's say, late March, the epicenter at the start was Mumbai, which is the commercial hub of the country, and the neighboring areas, particularly the city called Pune, which is the closest large city to Mumbai. It's like Boston and New York, if you will. And both the cities are in the state of Maharashtra. Maharashtra is the biggest state in terms of GDP contribution at about 15% out of the 30 states or so. So you will see that already the state that went first into the second wave has already started declining. So first, if you see the two cities, you'll see Mumbai has sharply declined already. And since most of my family lives in Mumbai, and friends live in Mumbai, and I'm continuously on chat, so the case count in Mumbai have fallen off dramatically from a high of 10,000 to what was yesterday. And this graph is not updated. This is a 7-day moving average. So yesterday the number was somewhere in the 2000s, 2,500, call it. So already the case count in Mumbai is 25% of what it was at peak. And the hospital beds is the most important way to know that the situation is certainly definitely improved, is the availability of hospital beds. And on social media, this thing, is floating around, that which hospital has hospital beds available and whatnot. At peak, it was a struggle to get hospital bed. Very big struggle. I know people, friends, family, extended, who struggle to get a hospital bed. Today, there are a lot of messages on social media which do say that there are few beds available there, few beds available in that hospital, and so on. So hospital bed no longer being a problem itself is the biggest indicator. And that's what you're seeing here on the right hand side top half. At a statewide, at Mumbai level, the load has come down, and at state level as well, Maharashtra, the curve has flattened and is slightly dipping down. India is still continuing the uptrend, because in other parts of India, they are still early in this curve. But as you can see, the band is curving for India as well. Next slide, please. Yeah, so the market, fortunately or unfortunately, the market and the economy don't really care as much for the deaths, humanitarian loss. What they care for is corporate cash flows, the market, right? And as it is, present value of future cash flows. Last year, there was a very harsh lockdown. And more than that, the worry was that it would be indefinite lockdown. Present situation, Modi is extremely reluctant to impose a nationwide lockdown. He's deferred it to states to take a case by case approach, a local approach, district by district approach of imposing lockdowns with varying severity. I was last year also fully in favor of lockdown. Not that my opinion matters at the national level, but a lot of people in the investment community were critical of Modi for imposing a very severe lockdown. I was, on the other hand, arguing that that was what saved India from a health crisis, because it's like very simplistic to say it, as people were saying last year, oh, there are only 25,000 cases all over India. What is the need for nationwide lockdown? Well, there are only 25,000 cases because of the lockdown. If you remove the lockdown, there'll be millions of cases. And India does not have the healthcare infrastructure to offer to those who are suffering the basic things like oxygen, right? And this is what this time it has happened. Because there's been no lockdown, the case count has shot through the roof. In my mind, lockdown should have been imposed, a severe lockdown should have been imposed just like last year to break the chain. Yes, that would have meant a quarter or two of economic hit to the GDP, but you bounce back. If you're down 25% this year, you'll be up 40% next year. Nobody dies because of, or very, the people who die because of lockdown are far fewer than people who die without the lockdown. But unfortunately, the government is not imposing so far the lockdown. And people who were arguing last year that the government should not impose lockdown have now started talking that, oh, the government should impose lockdown. Fortunately, they are realizing that lockdown is necessary. So lockdown may or may not happen. I would be for imposing a month or 2 months of lockdown. It'll break the chain. In the meantime, get vaccination done and then open it up. And you don't need to do as severe a lockdown as last time, because we've learned from last time. We know a lot more about the virus right now. So maybe manufacturing units can continue to operate. Units which have very few people required, they can continue to operate and whatnot. But the situation right now is there is a limited lockdowns, which is causing limited impact on the economy. So the people are, analysts are shaving off 1 or 2 percentage points off of the 12 to 13% growth that is predicted this year. In the overall scheme of things, that does not matter in my view, because that's not a permanent loss. We would have a stronger growth next year, just like we are. And even this year, people are just projecting what they want. The reality is very difficult to know whether it will be 12% or 20%, but certainly would be double digits this year, it seems like. But that's on the, so lockdown, if there is indefinite lockdown, that is what is a worrisome. A 1 month, 2 month lockdown does not cause any harm. And markets have already seen that movie before. If you look at the bottom row, that sums it up. Oxford Stringency Index, last year it was 96 to 100. India was the most stringent of the lockdowns. Right now it's at 74. If we go to next slide, I think we pretty much covered. We can open up for Q&A. Yes, we can. Let's just go to the one final concluding slide I want to say, because people get very nervous with macro. It's for my, in 35 years of investing as an individual or as a professional. One of the biggest lessons that I learned early on in life, and if you can bring that up, Dipojal, lessons from 2020, I don't know whether it's in this deck or the other. And so I put 2020 was a perfect year to exemplify those lessons, if you will. And so, in first time in my life, I wrote a newsletter. Would very much encourage people to read it, as the only newsletter that I've written in my life. And the newsletter is called Macro Shacro, kind of gives away the content, but what it talks about is lessons from 2020. And the biggest lesson, or basically the key lesson, which we break it up, is into the futility of predicting investment returns based on macroeconomic worries and events. And this is something I've strongly believed for last 30 plus years. It was one of the first lessons I learned when I started investing personally at the age of 13, when the market had rallied 100%, right? While it is very entertaining and everybody keeps themselves preoccupied with trying to predict the market based on macroeconomic worries and events, it is completely futile in our view. We've split this into three parts, this underlying lesson. Lesson number one is the usual perennial macroeconomic worries of the well-known unknowns variety are a colossal waste of time. So whether GDP growth rate would be 5%. So last year in January, people were worried whether India's GDP growth for the year would be 5%, as was consensus, or could it be 6% or 4%? Ultimately, it turned out to be minus 7.5%. And the market went up some mid-teens to high teens, and we delivered some mid-30s returns, one of the best years. So certainly, those are a colossal waste of time. Interest rates moves, Fed moves, and all these. Second, risks such as, or macroeconomic risks such as unknown variety, like the pandemic. Nobody has any clue before it hits. But more importantly, even if you have perfect knowledge, prior knowledge of what's going to happen to the real world because of such risk as pandemic, the market implication is completely unpredictable, which is what you saw last year. If in January you were told this is what's going to happen to the world, you would want to sell out of everything and maybe go short, and you would have lost a lot of money. And the biggest practical lesson, an important lesson, is lesson three. Investment decisions that are driven by macro considerations are fraught with very high risk of substantial absolute and relative losses. And that is the reason why we go, as I said earlier when I began, we go out of our way to make sure that our portfolio does not, by accident even, reflect any macroeconomic view which we might have, which to begin with we hardly ever have with any degree of conviction, if you will. So while I might have talked about a lot of things with very high degree of conviction today, apparent high degree of conviction, that is more as a human, as an observer, all that does not have any bearing on the team's management of the portfolio. It remains well balanced. Whether market goes up or market tanks, these macro views would have no bearing on the performance. As you saw last year, in the first quarter, market tanked. We were one of the best performing funds. And then the next 3-4 quarters, when markets rallied 100% or so, we were best performing, or one of the very best performing funds. And that is to do with the balanced portfolio approach. I think there's hardly anyone else who would have outperformed in both environments, the sharp down market in the first quarter and the sharp rallying market in the next 4 quarters. So with that, I'd like to pause, and hopefully there'll be a lot of questions and pushbacks to what I discussed.
In order to ask questions, we've got a Q&A button on the bottom of your page, on the menu bar. There's a Q&A there. If you'd like to just quickly type your question in, Prashant will see them and will be delighted to answer them. If you look, Prashant, click on the Q&A. I don't know if you can read that one.
Yes,
I'll read it.
Shall I read out?
Please do, yeah. Please do, yes.
What is the projection of the timescale when COVID-19 will be under control in India, and how long will the bounce back take? If you can predict this, or what is your hope? So I think, again, we've not done tremendous amount of forecasting work and all that, but as we discussed just now, I think by June, we will see the plateauing and the other side of the curve by the end of June, quite likely, as the vaccinations climb up and reach even 20% because of the younger population. And we are already seeing signs of the curve bending and slowing. And I've been, looking at this out of sheer interest. I do look at the case count every day, as I assume everyone does on this call. And the case count, certainly the second derivative has certainly slowed, and only a matter of time that the first derivative and the number will slow itself over the next few weeks. So to your question, sometime before end of June, we will see the other side, the mirror image of the curve, and vaccination is going to take us there. If there is a lockdown imposed, which I think is much needed to save lives, then it could be much sooner. It could be by mid-May itself. If we impose the lockdown today, by mid-May, the case count would have declined. What are the risks of losing control of the pandemic? So the risk is, we've already lost, India has lost control of the pandemic, and so did other countries when they were facing the, second wave and all that. And that is what you're seeing right now, the elevated number of cases and deaths. Right now, India's trying to regain control, I would say. The risk is, if it continues, let's say there's no vaccination given from now, which is not possibility, but assume no vaccination given. We just stop right now vaccinating, stop worrying about it. Let's go for herd immunity. Then over the next 3 to 6 months, pretty much everyone who uh, everyone would get contracted by this. A mortality rate would be somewhere in the fraction of a percentage points. If we take 1 out of every 500 people dying, then that would lead to some, I have done the math right now off the top of my head, I don't remember, but it's something around, adjusting for age cohorts and all that, it could mean 2.5 million deaths in total, compared to what is currently reported at about 200 to 250,000 deaths. But that's just talking about a impossible scenario. Um, so that is what how I would answer as the very worst case scenario, which is not probable, not likely. The most probable scenario I already mentioned. By June, we see the other side of the curve. By end of July, August, a rapid decline as we reach 25, 30%, 40% of population getting vaccinated. Do you see the current situation as a buy opportunity? I mean, the market's been fairly logical about it. The market's off like 3%, 4%. We did add to positions in the banking sector because banking sector got hit as the case counts ramped up mid-April. So around mid-April, as banking sector got hit, we did add to several of our banking existing bank positions. And that was good opportunity. All of those banks have come out with the results and their commentary has been very positive and confident because they've seen this movie before and they're much better prepared this time. They're very well provisioned as well. Can you please comment on, hold on, let me go in some kind of order. Otherwise I would, yeah, otherwise I would miss out. Could you please comment on the result of election yesterday? Modi seems to lose people confidence. Is it really reality, and what could be the financial impact? So I was not very surprised necessarily. I think there's some element of voting based on the mismanagement of the COVID situation, the second wave by the central government, where they did not call off the election results but continued to hold very large political rallies. So there's some element of that. He was up against a very fierce opponent, local opponent, who's been in the chief minister's role. Chief minister in India is like the governor of state in the US. So she has been there for 10 years. She's one of the most popular regional leaders in India. So is it a big negative surprise? I don't think so. And again, no material implications for the market of that. Can the vaccine deployment improve? What holds it down? So, yes, as we discussed, the vaccine deployment is slated to improve from 75 million odd per month, or 2.5 million at present, to twice the rate by August. What's holding it down right now is one thing, which is the slower production. We are using up whatever production. There's ample capacity, there's ample infrastructure to administer vaccines in India. That's one thing India has, developed good infrastructure for, given the decades of experience in administering polio and TB and other vaccines to pretty much everyone of the population. So as vaccine production ramps up, this would improve. India is the largest vaccine producer in the world, by the way. It's just that the population is also close to the largest. India actually, in normal times, supplies vaccine, is the largest exporter of vaccines as well, not just producer for self. Has volatility led to any bottom-up changes to the portfolio due to valuation opportunities or changes in fundamental view? If so, what are these changes? So as I mentioned, predominantly we added to a few financials in the portfolio. Besides, so that would have been the within financials would have been the biggest addition to the portfolio. We did also add to a couple of other names. One that is in jewelry retail, as an example. So that one also got beaten up a little bit because of this, and it's again a very temporary phenomenon. They are gaining. They gained a lot of market share last year because it's a organized, unorganized market is nearly 80-90% of jewelry business. So when people are more concerned about safety and social distancing, they go to organized sector. So the company Titan recently reported, as you might know, many of you might know, is it in the portfolio? They reported very strong numbers just last week, and we took the opportunity earlier in this month to add to that position when the stock pulled back. What is your experience with investor? Have you experienced substantial redemptions? No material redemption. In fact, net we have got inflows in the portfolio. So inflows have outweighed or continue to outweigh outflows. I don't have the number of the top of my mind, but we ended the month. The April month end AUM was more than 100 million higher than March month end AUM, and a good portion of it was inflows from domestic market and also some inflows from offshore market. I would say the domestic market investors are a lot more comfortable with this surge in COVID, despite them facing the healthcare issues. I think the media stories around the world are far more scary, even though I'm not saying they're far from reality. It's just that if you live in India, you are seeing those stories happening in normal times as well. Whereas if you are living in New York and opening New York Times, the New York Times is likely to write up a fairly long story during such times about how things are in bad shape in India. So that's why I find concern is more amongst offshore clients than amongst domestic clients. How does the Indian population rank Modi's government handling of the crisis slash vaccination? Do you any long-term risk to the government stability? So government has very strong numbers till 2024. So last election was in May 2019, which is for 5 years. He got elected till 24. So there's no risk to the stability of the government in 24. By 24, this would be long forgotten, unfortunately or fortunately. And there will be other issues that would be top of people's mind by then. So the answer is there's no risk. I'm not saying this right or wrong, but there's no risk to Modi's government at this time, or at least for the next 3 years. Can you please comment on portfolio positioning, recent changes, highest convictions? I think I already mentioned that to some extent. So portfolio always remains well balanced. So I talked about increasing some of the exposures to some of the banks, but that doesn't mean we become all of a sudden pro-cyclical in the portfolio and we are betting that things would be hunky-dory and all that. The portfolio always tends to be a bit defensive, our portfolio, always over many years, meaning when there are sharp down markets, we have a tendency to do better than the market. And that's because of our focus on good corporate governance. When markets fall sharply, companies with poor governance tend to fall more sharply, right? On a given day or in a given month or a week, right? So that defensive nature, and I don't want to mean that we are zero point 0.5 beta or something. That defensive nature is not because we are in pharma and IT and consumer staples and all that. We are underweight in consumer staples, for example, for quite some time have been underweights. But it's more that within each sector, corporate governance of companies that we own tends to be stronger than corporate governance of other companies, and that is what leads to a bit of defensive performance on how have you if you evaluate our performance in years when market is up, we tend to outperform by even more than in years when the market is down. So what I'm talking about, the defensive nature holds true more from a day-to-day basis or week-to-week basis. As long as you go to even a quarterly analysis, we have that analysis over the last, including my time at Goldman. The down market, down quarters or up quarters are very similar. If anything, up markets tend to lead to even stronger performance, but by a small, I mean, we're talking about splitting hairs now. What do you think of the humanitarian situation. So humanitarian situation is very sad and frustrating. The fact that people are dying because of lack of oxygen is very troubling. Oxygen is very cheap. If people were dying because they didn't have access to a $20,000 medication, that itself would be very sad. To die because of lack of oxygen, which is almost free, you know, is very sad situation. Not a whole lot to say on top of that. I think the best thing to do to get control of this humanitarian crisis to implement a severe lockdown, which there are a lot of calls for, but the government is resisting. But I hope they would implement one over the coming days, and that would bring the situation under control.
So we seem to have come to the end of the questions, Prashant. First of all, let me thank you very much for giving us that informative talk. And I'm sure we can probably arrange for some of those slides to be sent out to anyone who'd like them.
Yes.
And I'd like to thank the participants for listening today, and thank you all very much indeed. And I think that comes to the end of our morning.
Thank you so much. I would like to, thank everyone who's joined today.
Yeah.
And thank you, Philip and Kobe and everyone at Anglo for organizing it. And thank you everyone for joining today. Any questions, we are available and we'll circulate the slides post this call. Thank you again.
Thanks very much, Prashant.
Bye-bye.
Bye-bye.